The Lone Ranger.
Hello everyone, I'm Vince Collier. I am the Lone Ranger. I'm with Encompass Lending Group. Today's blog, I'd like to talk a little bit about your house payment and what goes into your house payment and how we figure that out. Normally when we talk about house payment, most people are pretty familiar with the term PITI. This is the major part of your house payment. Principal, interest, property taxes, and homeowners insurance. But there's one other piece of your payment that a lot of people are very unfamiliar with, or they know about it, but they're really not sure what it's for. And that's your mortgage insurance premium. Mortgage insurance is insurance policy which compensates lenders or investors for losses due to the default of a mortgage loan. It keeps these programs solvent. If they had to eat all the foreclosures and the billions of dollars that are going into our housing industry, these programs could never stay in existence. Mortgage insurance, can you stop? Mortgage insurance isn't new. It's been around a very, very long time. A little history lesson on mortgage insurance. I invited my friend, Dr. Morginski. The mortgage insurance began in the United States in the 1880s, and the first law was passed in New York in 1904. The industry grew in response to the 1920s real estate bubble, which was entirely bankrupted. After the Great Depression, the federal government began insuring mortgages in 1934 through FHA and VA. But after the Great Depression, no private mortgage insurance was authorized in the United States until 1956, when Wisconsin passed a law allowing the first post-depression insurer to be chartered. This was followed by California, of course, in 1961, which would become the standard for other states' mortgage insurance laws. Thank you. Thanks, Doc. So when we talk about your house payment, be sure that you understand what that mortgage insurance is for. Typically, anytime you put less than 20% down on your mortgage loan, you're going to have to pay some form of mortgage insurance. There's a little difference in terminology when we're talking about an FHA loan or a USDA loan. Typically we call it MIP, or a mortgage insurance premium, where on a conventional loan it's PMI, or private mortgage insurance. But they're both exactly the same thing. The differences in these programs is PMI on a conventional loan will typically be reduced the more money that you pay down on your down payment. So you're going to pay less mortgage insurance on 10% down than you would 5% down. Where on an FHA loan, that's static. You're going to pay the same percentage for the life of the loan or until you reach that 20% equity mark. Also, a lot of people don't realize, even if you put 20% down on an FHA loan, you're still required to pay mortgage insurance for the first 5 years. So typically when we put down 5% or more, we're going to steer the buyer towards a conventional because it's just a better deal for the buyer, and especially if they put 20% down, because you're not going to want to pay mortgage insurance if you don't have to, so we're going to go towards the conventional product. Be sure you talk to your lender before you lock in a program and find out the ways that you can reduce that mortgage insurance premium, because that's coming right out of your house payment. And the higher your house payment, the lower your buying power when it comes time to get a loan. So anyway, there you go. Talk about a mortgage insurance. Stop. Anyway, that's our talk about mortgage insurance, and if you have any questions, please give me a call. My contact information is at the bottom of the page, and then we have a contact link up above where you can actually submit a question. I'll be happy to answer it in an email format. So anyway, have a great day. It was always good to see you, and don't forget, the Lone Ranger writes again.